Silver isn't rallying because people got emotional. It's rallying because the physical supply chain just started saying no. And the paper market is scrambling to pretend that no is just noise. That's the conflict right now. The price action looks like a simple blow-off and pullback story, while the plumbing underneath looks like stress, rationing, and forced behavior. And the mainstream will miss the real signal again, because it's not hiding in a headline. It's hiding in the mechanics, which contracts get bid, how fast metal moves, what margin policy forces leverage traders to do, and which countries quietly change the rules on imports and strategic materials. Stay with me, because by the end you're going to have a clean framework for the $100 question. What has to break for it to become likely? What has to normalize for it to fade? What levels matter and what you watch next week that tells you which path you're on. Here's the first uncomfortable fact. Silver just had a year so violent that even the exchange had to keep raising the price of leverage to slow it down. Silver surged roughly 147% in 2025, tagged an all-time high around the mid-$80 area earlier this week, and even after a sharp reset, it was still trading in the low to mid-70s at the start of 2026. That's not a normal chart. That's a market that ran into structural constraints, then tried to shake out the weak hands with volatility, then ran into them again. And right there is the trap. People think volatility means the story is over. In real commodity squeezes, volatility is often the story, but that's not the part that matters. The part that matters is why the volatility is happening at this specific moment, and what the volatility is forcing the biggest players to do behind the curtain. So let's talk about the phrase that set the internet on fire: silver shipments being seized. If you hear that and you immediately jump to a single dramatic explanation, you're already in the emotional manipulation zone, because seized in the real world can mean at least 3 different things, and only one of them is the kind of sensational story people want to share. 1, literal seizures, customs and law enforcement confiscations tied to documentation, smuggling, sanctions, or a crackdown on illicit flows that suddenly become worth the risk when the metal price explodes. 2, practical seizures, delays and holds, paperwork, tariffs, licensing, routing changes, insurance constraints, where metal isn't confiscated, but it gets frozen in transit, and time becomes the scarce resource. 3, the market's version of seizure, the one traders underestimate, metal getting pulled into delivery, pulled into industrial procurement, pulled into private vaulting, taken out of the liquid pool that normally keeps the paper price tethered to reality. And when that third seizure happens at scale, the paper market can trade all day and still fail to clear the real demand without repricing. That's where the real pressure starts, because silver is not just an investment story, it's also a component story. It's used, consumed, embedded, and in many applications, it doesn't come back quickly. And that leads us into the hidden detail that reframes the entire debate. Gold has a backstop that silver doesn't. Gold has deep, mobilizable stockpiles, sitting in official hands and in a global lending ecosystem that's been built over decades. Silver doesn't have a comparable lender of last resort buffer. There are inventories, yes. There are vaults, yes. There are holders, yes. But the market structure around silver is less forgiving when physical tightness shows up, because the available, deliverable, ready-to-move metal can be a much smaller slice of the total. That's the asymmetry. And when you combine that asymmetry with leverage, you get something that looks like a normal pullback, right up until it doesn't. Because if the physical side stays tight, every dip becomes a procurement opportunity, and every bounce becomes a margin problem for the other side. The next detail is what flips the whole setup. The paper market is not a warehouse. Futures are a pricing engine. They're a mechanism for transferring risk, discovering price, hedging production, and speculating. They work beautifully when the physical market is flexible, when metal can move, be refined, be delivered, be swapped, and be financed without friction. But when the physical side tightens, the pricing engine starts coughing. In silver, that cough shows up in places most people never look. In spreads, in term structure, in nearby contracts behaving wrong, in odd premium behavior, in delivery interest, in how quickly arbitrage channels get clogged. Let's simplify it without dumbing it down. Imagine 2 layers. The top layer is the paper layer, futures contracts, options, leverage positions, and the ability to control a large notional amount of silver with a relatively small amount of cash posted as margin. The bottom layer is the physical layer, mined supply, byproduct output, refined bars, logistics, vault categories, and end-user demand that doesn't care about your chart pattern. Under normal conditions, these layers talk to each other smoothly. Under stress, they argue. And when they argue, the paper layer tries to enforce discipline through margin and volatility, while the physical layer enforces discipline through availability and premiums. That conflict is exactly what you're watching. Because in late December, when volatility exploded, the CME raised margin requirements on precious metals again. On one widely reported adjustment for silver, The margin on the March 2026 contract jumped by roughly $3,000, moving from around $22,000 to roughly $25,000 per contract. That sounds like trivia until you do one quick calculation. A single COMEX silver futures contract represents 5,000 ounces. If you're running 10 contracts, you control 50,000 ounces. If you're running 100 contracts, that's 500,000 ounces. Now take that margin hike, $3,000 per contract. If you're carrying 100 contracts, the exchange just demanded roughly $300,000 more cash from you immediately just to keep the same exposure. And it's not a polite request. It's the rules. If you don't post it, you reduce, you liquidate, or you get liquidated. That is forced behavior. And forced behavior is gasoline in a thin market, because forced liquidation can smash price down even when the underlying thesis is still alive. And forced liquidation can also set up the next leg higher because it clears weak hands and concentrates exposure into players who can actually fund it. But that's not the part that matters. What matters is what the margin hike tells you. The exchange is acknowledging that the move is not normal, that intraday swings have become wide enough to threaten stability, and that leveraged positioning has grown large enough to require cooling. The market hears that and assumes top. Sometimes that's right. Sometimes it's just the first warning that volatility is going to be used as a weapon. And that's where smart retail investors get emotionally trapped. They watch a vertical move, then a violent pullback, and they interpret the pullback as proof the story was fake. Meanwhile, the physical market can be tightening in the background, and the next leg starts without them because they sold the bottom of a margin-driven flush. This is why your edge cannot be feelings. Your edge has to be mechanics plus a checklist. So let's build the checklist by stacking proof in layers, because one argument is never enough in markets like this. First layer, chart structure. Silver didn't just rise, it broke into an all-time high zone, tagged roughly the low to mid-80s, then snapped back into the 70s with speed. That tells you two things at once. One, buyers were strong enough to drive a breakout into territory that forces every model to recalibrate. Two, the market is leveraged enough that when the exchange tightens margin or liquidity thins, the unwind is violent. Both can be true. The second layer, volatility policy. Multiple margin increases since late September, with another notable hike around the end of December, is not the signature of a sleepy market. It's the signature of a market where leverage is becoming destabilizing. And when leverage is destabilizing, the path to higher prices becomes jagged, not smooth. The third layer, macro tailwinds. Precious metals began 2026 strong after a record-breaking 2025, with narratives centered on geopolitical tensions, expectations of interest rate cuts, and capital flows looking for alternatives. When rates are expected to fall, the opportunity cost of holding non-yielding metals becomes less punitive and the hedge demand can return fast. But here's the twist. Those macro drivers explain why interest exists, not why the market behaves like it's short of something. Macro tells you direction, microstructure tells you pressure, and silver is a microstructure story right now. The fourth layer, policy and strategic framing. Silver was reported as being designated a critical U.S. mineral, a shift in narrative from just a precious metal to strategic industrial asset. Whether you agree with the politics or not doesn't matter. The market implication matters, because critical framing changes incentives. It affects permitting priorities, domestic project support, procurement behavior, and the way institutions talk about supply security. It's not that a designation magically creates ounces. It's that it changes the behavior of the players who must secure ounces, and behavior changes faster than supply. The fifth layer, trade flow friction. One major example that matters for this specific seized shipments narrative is India restricting silver imports through March 31st, 2026, after a surge in inflows, particularly from some ASEAN sources. Again, don't overdramatize it. That doesn't mean the world ran out of silver. It means policy can suddenly add friction to flows, and friction in a tight market amplifies price signals. When flows get restricted, rerouted, delayed, or made more expensive, the local premium can jump, and arbitrage channels start to clog. And when arbitrage clogs, the market loses its shock absorber. Because if this one mechanism breaks, the math changes. This is the global arbitrage spine in plain language. Silver is a globally traded commodity, but it doesn't trade as one unified pool. It trades as a network of pools connected by logistics, financing, and rules. If region A has scarcity and pays up, metal should move from region B to region A. That movement is arbitrage. Under calm conditions, arbitrage keeps prices aligned. Under stress, arbitrage gets throttled by shipping lead times, insurance, customs, tariffs, compliance, and the simple fact that physical metal is heavy, valuable, and increasingly targeted. And when the value spikes, so do the incentives to steal, to smuggle, to intercept, to scrutinize. That's why the seized shipments story becomes louder in a year like this. Higher price makes the same behavior more visible, more enforcement, more theft, more risk controls, more delays, and the delays function like a temporary shortage even when total supply hasn't changed. That's the hidden mechanism people miss. In tight physical markets, time becomes inventory. A bar that arrives 3 weeks late is, for those 3 weeks, effectively not there. And procurement managers don't hedge with optimism. They hedge with action. They pay up for certainty. They lock supply. They pull forward orders. They grab what's available. And that's how a slow-moving physical tightness can suddenly look like a panic. But that's not the part that matters. The part that matters is how this interacts with the paper market's pricing engine. Here's the key. The paper price can be right in the abstract and still fail to clear the physical market in the moment. That shows up as a divergence between the headline spot price and the cost to actually acquire deliverable metal. It also shows up in the curve. In commodities, the term structure is the lie detector. When near-term contracts trade above deferred contracts, that's backwardation, and it can signal near-term scarcity, high convenience yield, or urgency. When deferred trades above near-term, that's contango, often reflecting storage and financing costs in a well-supplied market. Now, you don't need to become a curve trader. You need to understand what it forces participants to do. If the front is expensive, it incentivizes immediate supply, discourages hoarding, and signals stress. If the back is expensive, it incentivizes storage and carry trades. So if you see the front end tightening while price is volatile, that's the market telling you the physical side is pulling. And that's why you keep hearing about paper versus physical tension. It's not a conspiracy. It's a structural mismatch under stress. The paper market can create exposure instantly. The physical market cannot create ounces instantly. So the bridge between them is inventories, logistics, and financing. And the most underappreciated detail in silver supply is that most silver isn't mined on purpose. A large portion is produced as a byproduct of mining other metals. That means you can't simply turn on silver supply because price is high. If copper output doesn't expand, if lead zinc output doesn't expand, if the byproduct stream doesn't expand, silver supply response can lag. Even primary silver miners have lead times, permitting constraints, cost pressures, declining grades, and capital cycles that don't respond in weeks. That lag is why silver can squeeze harder than people expect. The market can demand more now, but the mines can't deliver more now. So the adjustment happens in price and in who gets the metal. And that's where the institutional behavior just turned loud. When silver is framed as both strategic and industrial, the buying is no longer just investors chasing a chart. It becomes entities securing supply. And that kind of buying behaves differently. It buys dips. It buys quietly. It buys through intermediaries. It cares about delivery timing more than entry price. And it doesn't stop just because the candle turned red. That's why you can see a savage pullback and still have underlying tightness. But here's where you have to be disciplined. None of this means $100 is inevitable. $100 is a scenario, not a destiny. The word inevitable is bait. It's a tool to pull you into certainty, and certainty is the fastest way to blow up your risk management. So let's do the $100 math without hype. From roughly $73, $79 to $100 is about a 5% move. From the recent all-time high around $83, $62 to $100 is about a 19.6% move. In a normal asset, those are big moves. In silver, with this volatility profile, those moves are not fantasy, but the pathway matters. A market can go up and still destroy participants who sized wrong, timed wrong, or panicked. That's why the next week matters more than the next year in terms of how you survive it, because the calendar is the catalyst here. The first week of January is where liquidity can be thin, positioning resets begin, funds rebalance, and the market's risk systems update. It's also where the market processes the aftershocks of late December margin changes. The exchange raises margin, traders delever, liquidity thins, the market whips, headlines scream crash, and then the question becomes, did the underlying physical tightness ease, or did leverage simply get shaken out? That is the fork, and you can't answer that by staring at a single 5-minute candle. You answer it by watching what the market is forced to do. So let's talk about who's forced right now. Leveraged longs are forced to reduce when margins rise and volatility spikes. Leveraged shorts are forced to cover if price rises into zones that trigger risk limits, margin calls, and stop-outs. Producers are forced to hedge when prices are high enough to lock cash flows, but they can't hedge what they can't deliver, and they won't hedge aggressively if they believe scarcity gives them pricing power. Industrial buyers are forced to secure supply when procurement risk rises because a production line doesn't care that a chart looks overbought. Dealers and refiners are forced to manage inventory categories, deliverable versus non-deliverable, committed versus uncommitted. Because under stress, the market discovers that not all inventory is equally available, and governments are forced to manage trade policy when import surges distort local markets or raise security concerns. That's why you see things like import restrictions. That's why you hear more about seizures. That's why you see freight and insurance behavior change. And that's why the story can accelerate. Because if enough participants become forced at the same time, the market stops being an auction and starts being a queue. And queues reprice brutally. But that's not the part that matters. The part that matters is the invalidation. You don't earn trust by promising moon targets. You earn trust by stating what would make you wrong. So here are the realistic counterpoints that can kill or delay the $100 narrative. First, demand destruction. Silver has industrial uses, and if prices spike too far, too fast, some buyers defer purchases, redesign components, thrift usage, or shift to alternatives where possible. Not everything can substitute, but some can. Second, scrap and recycling response. Higher prices can pull more silver into the market from scrap streams, secondary supply, and liquidation. The response isn't immediate, but it exists. Third, curve normalization. If term structure stress eases, if spreads stop screaming, then the urgency premium fades even if spot stays elevated. Fourth, policy dampeners. Import restrictions, compliance crackdowns, tariff clarifications, and regulatory actions can slow flows, change incentives, or redirect demand in ways that cool the immediate squeeze dynamic. Fifth, the simplest one, the market can just run out of incremental buyers at the margin for a period, especially after a historic year. And price can consolidate violently without breaking the long-term thesis. That's the part that breaks people psychologically. A thesis can be right, and your timing can still be wrong. And that's why you need the viewer psychology shield right now, because the market will try to make you do two stupid things with maximum confidence. It will try to make you buy high out of relief after a big green candle, because you'll feel like you missed it and you need to catch up. And it will try to make you sell low out of humiliation after a sharp flush, because you'll feel like the market proved you wrong. That's the emotional manipulation pattern. Volatility is not just a statistic, it's a behavioral weapon. Exchanges raise margins into volatility. Volatility forces liquidation. Liquidation creates dramatic candles. Dramatic candles create emotional narratives, and emotional narratives create bad decisions. Your defense is a process. Your defense is defining trend signal versus noise. Trend signal is structural. Policy shifts, persistent physical tightness, sustained demand, curve stress, repeated failed breakdowns at key levels, and forced buying dynamics that show up across timeframes. Noise is the intraday chaos that happens because leverage is being repriced and liquidity is thin. Both move price. Only one should move your plan. So here's the two-scenario lens that keeps you sane. Scenario one is the controlled pullback and retest. That's where silver chops, retraces, and tests a floor zone, often near prior breakout areas, while spreads and physical availability don't fully relax. In that scenario, the market is digesting gains and shaking out leverage. It feels bearish in the moment. It's loud. It's humiliating. And it can still be constructive if the floor holds and the market reaccumulates. The tell in that scenario is not a single bounce. The tell is resilience. Dips get bought faster, breakdown attempts fail, and the market stops making new lows even when headlines stay negative. Scenario two is the continuation squeeze. That's where price doesn't give you the nice entry, because physical urgency and forced covering overpower the desire to consolidate. In that scenario, you see gap risk, whiplash, and fast moves that blow through levels. The tell, there is acceleration plus stress, front-end tightness, frantic repricing, and a market that refuses to stay down even after margin-driven dumps. In either scenario, your job is not to predict with ego. Your job is to watch confirmations and invalidations like a hawk. Now, you asked the loaded question, are we heading to $100? Here's the honest, mechanics-based answer. $100 becomes plausible when the market sees sustained evidence that physical supply cannot respond quickly enough to rising demand, and that paper leverage is trapped on the wrong side. The combination creates reflexivity. Price rises, margins rise, shorts cover, liquidity thins. Physical buyers pull forward, spreads tighten, and the next marginal ounce gets bid at a higher price because availability becomes the priority. That loop can overshoot. That's how you get the kind of move that takes you from the 80s to triple digits without giving you time to emotionally adapt. But it's not guaranteed, and it's not free. The pathway is lined with traps. The traps are the very volatility that makes the move possible. So let's get concrete about what to watch next without pretending we have a crystal ball. First, watch the zone around the prior all-time high area in the low to mid-80s. Markets remember levels like that. If silver can reclaim that zone and hold it on closing bases after a margin-driven flush, it tells you buyers are not just momentum chasing, they're persistent. Second, watch how price behaves in the low to mid-70s area where it's recently been trading after the high. If that region becomes a floor rather than a trapdoor, that supports the controlled retest scenario. If it fails cleanly and the market can't reclaim it quickly, it suggests deleveraging is still in control. Third, Watch the nature of rallies. Weak rallies in a squeeze environment get sold immediately and fade. Strong rallies in a squeeze environment don't just rise, they refuse to be faded. They pull bids forward, they make sellers chase. Fourth, watch policy and trade flow headlines with a cold eye. Import restrictions like India's matter not because they remove all supply, but because they can reroute flows, create local premiums, and add friction at the worst time. Fifth, watch the cost of leverage story. If margins keep rising and yet price keeps stabilizing and pushing higher, that's a signal that the market is absorbing deleveraging without collapsing. That's powerful. If margins rise and price implodes and stays weak, that's a signal the move was more paper-driven than the narrative claimed. Sixth, watch the physical pulse. Premiums, availability chatter, delivery interest, and the stories about shipments being delayed, intercepted, or seized. Don't treat those stories as proof of apocalypse. Treat them as friction indicators. When the metal becomes valuable enough, enforcement and crime rise. When enforcement and crime rise, logistics gets more expensive. When logistics gets more expensive, delivery timing tightens. When timing tightens, the physical premium becomes more important, and that premium can drag the paper price higher over time, but only if it persists. And that's where the real discipline is. Persistence over panic. Because if this one metric shifts, the whole narrative shifts. That metric is urgency. You can call it convenience yield, you can call it time preference, you can call it how badly people need it now. In a normal market, nobody needs silver now. They can always source it. In a stressed market, now becomes expensive, and the curve tells you that. So when you hear seized shipments, don't just ask, is it true? Or ask the better question. Does it increase urgency for real buyers in the next 2 weeks? Because the next 2 weeks is where squeezes live or die. Not in 10-year charts, in delivery windows and margin calendars and funding and liquidity. And we're sitting right in that window. Now, let's address the institutional skepticism head on, because your audience is not naive. People who watch metals don't trust institutions by default. They assume incentives are misaligned. And in markets like this, incentives are everything. Exchanges want stability, clearinghouses want protection, banks want manageable risk, funds want controlled volatility, industrial users want supply certainty, governments want orderly trade and compliance. None of those incentives are designed to make your chart look pretty. So it shouldn't surprise you that when silver runs hard, you get a pileup of stability mechanisms, margin hikes, tighter risk limits, more scrutiny on flows, more restrictive trade policy. It can look like suppression if you narrate it emotionally. It can also be explained as risk management if you narrate it mechanically. Either way, the effect on price can be the same. Short-term dumps, long-term tightening, and a market that becomes harder to trade but more dangerous to ignore. That's why the smartest posture is not trust or conspiracy. It's incentives plus evidence. Look at what participants are forced to do, not what they say. And that's where the opportunity for audience trust is right now. You don't need to sell a fantasy. You need to give people a map. Here's the map in one breath. Silver just came off an historic year with an all-time high near $83. Six, and a reset into the 70s. While margin hikes raised the cost of leverage, a critical mineral framing changed procurement psychology, and trade policy added friction to flows. Seized shipments should be read as a mix of literal enforcement and the deeper phenomenon of metal being pulled out of the liquid pool. And the path to $100 is possible if physical urgency persists and paper positioning gets trapped. But it will be violent, and the market will weaponize that violence against your emotions. Now take that map and apply the final checklist. If you're watching next week, you want answers to 3 questions. 1, does the market stabilize after margin-driven chaos, or does it keep cascading? 2, do dips get absorbed quickly, or do they become air pockets? 3, do the signals of urgency persist? Policy friction, procurement behavior, and curve stress, or do they fade back into normal commodity carry? If the answers point towards stabilization, absorption, and persistent urgency, the odds of revisiting the highs rise, and once you're back near the highs, the distance to $100 is no longer a myth. It's a roughly 20% extension from a level silver has already proven it can approach. If the answers point toward cascading weakness, failed bounces, and fading urgency, then $100 becomes a longer-dated narrative rather than an imminent one. And in both cases, the risk remains the same. Volatility will whip you even if the thesis is correct. So size and time horizon matter more than bravado. You don't have to swing for the fences to benefit from understanding the mechanics. You just have to stop letting the market hijack your nervous system with every candle. If you want to be on the right side of this story, think like a risk manager first and a forecaster second. Define the levels you respect. Define what would make you wrong. Define what you're watching that's outside the chart. And then let the market prove it instead of begging it. One last thing, because it's the subtle community signal that separates tourists from professionals. You don't need to believe in $100 to build a high-quality plan around the possibility. You just need to be the kind of person who doesn't get tricked by volatility, who can hold two scenarios in mind without panicking, and who can update as evidence changes. If that's you, you're already ahead of most of the crowd watching silver like it's a lottery ticket. And if you want this channel to keep doing it this way, mechanics, evidence, incentives, and a checklist you can actually use, then stay in this corner of the market with us, because the next move won't be explained by the loudest headline. It will be explained by the pressure in the plumbing, and the plumbing is where the real money gets made and the real mistakes get avoided.